The U.S. economy, I think, will slow down in 2025. The one thing that we haven't been good on is the timing of the slowdown that will eventually occur because the money supply has been contracting since the summer of 2022. And we've only had four big contractions in the money supply since the Fed was founded in 1913. And all four of those have resulted in recessions.
We're entering what could be one of the most dangerous times geopolitically since the Second World War, and what could possibly be an economic slowdown in 2025, according to our next guest, Steve Hanke, professor of applied economics at Johns Hopkins University. Professor Hanke is a fan favorite, regular on the program, and before the new year, I like to get his outlook for the major themes of 2025 that impact all of us, whether or not we're in the finance industry or studying economics. These themes impact us all. Thank you very much for joining us once more before the end of 2024. Professor Hanke, good to see you again.
Great to see you, David. Happy New Year to you.
Happy New Year to you and to all watching.
As well as our friends who are going to view.
That's right. Our friends, the viewers, can submit questions to Professor Hanke. I'll put the email where you can reach him down below. But let's start with the bigger themes that you're watching out for 2025. We'll talk about the Fed. We'll talk about the economy, your outlook for growth. Let's start with your statement that you made to me offline where you said that geopolitically, this is the most tense time since the Second World War. What do you mean by that?
Well, if you just look at things, just look at the political scene. We have, as a result, really, of the war in Ukraine, the sanctions that have been imposed on Russia from the West, and the fiscal contributions for military equipment and so forth that the Europeans have put up, they've almost bankrupted themselves, the Europeans. And we've had one government falling after another, including two of the big powerhouses in Europe have dysfunctional governments, or a government in limbo in Germany, and essentially a dysfunctional government in France. So that's kind of and the economies in Europe are just completely tanked and falling way behind the U.S., for example. So that's Europe. That's a big zone. How about the United States? Well, we have a new sheriff will be in town, Donald Trump, starting on January 20th, and Trump makes a lot of noise, but in reality, we don't exactly know what he's going to do. So that's an uncertainty, a fairly big uncertainty. The U.S. economy, I think, will slow down in 2025. Now, as you know, John Greenwood and I use the quantity theory of money to predict the course or trajectory of nominal national income, nominal GDP, if you will. And nominal GDP includes the real rate of growth in the economy and inflation. Well, we've gotten the inflation thing absolutely right on target, going up and going down. The one thing that we haven't been good on is the timing of the slowdown that will eventually occur because the money supply has been contracting since the summer of 2022. And we've only had four big contractions in the money supply since the Fed was founded in 1913. And all four of those have resulted in recessions, or in one case, actually, the Great Depression. The contraction of 1929, 1933, the money supply led to the Great Depression. So this hasn't happened yet, but it's baked in the cake, and it will happen. It's just been a lot slower in coming than Greenwood and I ever imagined. So that's the real part of nominal GDP in the United States. Slow down going into 2025. What about the inflation component? The inflation component is also continued. That we've been right on target with. It has been falling, and it will continue to fall. I think we'll probably see some headline CPI numbers that are below the Fed's target at 2% in 2025. So that's kind of the economic scene and say, shall we say, the political scene in both Europe and the United States. What about the big elephant in the room? China. China's in a slowdown, and China is in a slowdown because, of course, the money supply is growing at a much slower rate than Hanke's golden growth rate, a rate of growth in the money supply consistent with hitting the Chinese inflation target at 3%. They have virtually no inflation in China. It's 0.2%, and it's very slow real economic growth. And the reason for that is that the money supply is only growing at about 7% per year, and the golden growth rate 11%, a tad over 11%. So that's kind of the economic. Now let's get more into the dynamics of things that are going poorly, let's say, and might end up going even more poorly. One is the war in Ukraine, which is in its third year. We've got a big war going on in the Middle East. We've got the U.S. just itching to get in a war with China, of all things. And then we've got a lot of little things going on that are very bad, like the civil war in Sudan. I mean, we're going to have a huge famine in Sudan, and we're talking about big numbers. I mean, it may be over 1 million people. So there are a lot of uncertainties associated with these wars, as well as the dysfunction in the political scene and the economic slowdown. I don't think much of any of this is priced into the markets at all. And remember, when you say the markets, the only market really that counts is in the United States. 70% of the market cap of all the equity markets in the world is accounted for by the U.S. markets. In 1980, that number, David, was only 30%. It's grown tremendously. And so the U.S. capital market just completely dominates everything. So when I'm really talking about the markets, we're talking about the U.S. market, and the U.S. market is overpriced, overvalued, and overhyped. I think the U.S. economy is overhyped. I think AI is overhyped. I think Bitcoin is overhyped. There's a lot of overhype going on here. And by the way, it's overhyped because everyone is on the overhyped bandwagon. You can't find anyone that is uttering something like I'm uttering. Of course, I am a natural contrarian. I've always been a contrarian as far as trading goes.
By the way, since you brought up Bitcoin, a few changes will happen next year that we are fairly certain of. One, perhaps monetary policy. We'll talk about that in just a minute. But number two, it sounds like President-elect Donald Trump is pretty serious about this Bitcoin strategic reserve. He doubled down in a recent press conference. This was even asked to Jerome Powell at the last FOMC conference. Take a listen to what this reporter had to say to Powell and Powell's response.
So if I may, speaking of assets that have been buoyant, do you see any value or benefits in the U.S. government building a reserve of Bitcoin?
We're not allowed to own Bitcoin. The Federal Reserve Act says what we can own, and we're not looking for a law change. That's the kind of thing for Congress to consider, but we are not looking for a law change at the Fed.
I think he may have indirectly answered the question. I don't know. But Another note just on this before I get your response, Professor. Senator Cynthia Loomis, one of the architects of this plan, recently told CNBC.
We got off the gold standard a long time ago. My question is how much you would spend tax dollars at a time when we're talking about trying to reduce costs. How much would you spend on Bitcoin as part of this reserve?
We wouldn't have to spend any new dollars. We have reserves at our 12 Federal Reserve banks, including gold certificates that could be converted to current fair market value. They're held at their 1970s value on the books, and then sell them into Bitcoin. That way, we wouldn't have to use any new dollars in order to establish this reserve. The United States already holds over 200,000 Bitcoin in the asset forfeiture funds. So that would be the initial source of Bitcoin. So no new money spent on this reserve.
So what she's suggesting on top of buying new Bitcoins is simply trade in gold for Bitcoins. Anyway, I'll let you comment on what Powell said and also what Senator Loomis said.
Well, I think Powell was diplomatic, but he was correct. He basically said they're just not allowed to own it, and he was hoping there would be no change in the law that would allow them to own it. That's actually what he was saying. He knows very well it's nothing but a highly speculative asset with zero fundamental value. Now, as far as Loomis goes, Senator Loomis from Wyoming, I should say, she's entered my Hanke's Dictionary of Economic Stupidity quite some time ago. So I think this is just a stupid idea. And by the way, the whole idea of Bitcoin, because this does get into economic growth, what you're doing is funneling potentially liquid resources. In other words, the difference between the amount of your income and the amount of your consumption is what? Savings. And you save because, remember, the new book I have out with Leland Yeager, Capital, Interest, and Waiting. What's waiting? Waiting is not consuming all of your income and waiting to receive a return, an interest rate, and consume later, waiting to consume later rather than consuming everything now. Now, the diversion of waiting or savings into Bitcoin does what? Well, it puts a drag on the economy because those savings are not invested in real capital assets that produce things. It just sits there. It's like buying old masters. What does that do? It diverts waiting and savings into old masters that just sits there and is never invested in bankable projects that actually produce anything and increase productivity and so forth in the economy. And if we don't increase productivity, we have a real problem. Because that fundamentally is what underlies improved standards of living and prosperity in an economy is increases in productivity. So I think that's enough on the strategic reserve. I'm completely opposed to it. I think it's the stupidest idea. But it's part of this overhyped aspect of things going on, David.
Yeah.
And overpriced and overvalued.
But the idea of the government adopting Bitcoin, what is that going to do for capital markets?
Nothing. As I say, it's basically going to slow down productivity.
Okay.
It deadens the positive aspect of waiting. That is not consuming today, saving, putting those loanable funds into bankable projects in anticipation of getting a rate of return, an interest rate that allows you to have a bigger pie at the end of the day and either consume part of that or save even more and wait some more for more returns, that is just taken out of the system. And once it's taken out of the system, it's just dead money, basically.
What if we were to look at it a different way? Say, approach Bitcoin like it's just another currency, like we're stockpiling, euros as a reserve or whatever the case may be. Would that make more sense to you?
Well, it makes more sense only in the sense that currencies are actually used. Bitcoin is used for very few transactions. A tiny portion of that is used, and mainly for illegal activity. If you want to call that use, I actually, on a net basis, it's probably negative, because the use, if you're using it in a criminal activity, I put a minus sign in front of that number, whatever it happens to be. So if you subtract that from that, if you add up that negative number and what little positive transactions are taking place, you end up on a net basis of being negative. So it's basically a negative aspect. It's draining off potential productive investments out of the economy. Bitcoin is.
Well, moving on to broader, I'll have to get you on to debate somebody who is more pro. That'll be a lot of fun. Comment down below if you'd like to see that. We can set that up with Professor Hanke.
A logical debate's very difficult with these people. I've engaged with them many actually years now ago, but these people are like religious fanatics. Do you want really to debate a religious fanatic?
What does the government have to gain from this? I mean, think about it this way.
Nothing.
Donald Trump already won the election. He doesn't need to, pander to Bitcoiners anymore. He could just say, I want to, you know what, I think.
Well, he's in the business. He's talking his own book. Or his son's own book. That's what's going on.
Okay. Well, there's that. Senators being a part of this. I mean, you're seeing a lot of more pro crypto people being appointed to members of the government. The SEC chair, Gary Gensler, is being replaced by Paul Atkins, who is a lot more pro crypto. Trump is selecting a lot of people within his own inner circle who are much more pro Bitcoin, pro crypto. He wants a shift in the broader government. And what we're going to see, perhaps, Professor, is just more regulations or fewer regulations against Bitcoin and more in favor of. See change happening.
David, have you looked at the magnitude of the political contributions prior to the election? It was totally dominated by crypto. I mean, these guys are buying their position. They go on and on about democracy. This is you just buy it.
Okay.
So this doesn't surprise me. I don't have the precise numbers in front of me. I didn't know we were going to be talking about this, or I would have looked it up. But I think something like 2/3 of the political contributions this last presidential go around were from crypto.
Yeah, we'll have to look that up later. We'll follow up on that next time, Professor. Let's move back to the FOMC.
Let's just leave it this way. It was a non-trivial amount, Dave.
Yeah, it was. You're right. The exact amount I don't have off the top of my head.
And then the United States, the way democracy works now, they go on and on about democracy, but you buy things. Why do you think we have all these lobbyists in Washington, D.C.? With Biden, the lobbies just exploded. They've always been there. They've always been big, but they have just exploded. And one reason for that, if you get the government involved now, as Biden has, and it looks like Trump is going to continue, this kind of industrial policy where major economic decisions about how capital is going to be allocated in the economy, where those decisions are made by politicians and bureaucrats in Washington, that opens the door for lobbyists and payoffs and corruption. So we're going to have with Biden, we had an explosion in crony capitalism, and I anticipate that that's going to continue with Trump, because if Trump is going to impose tariffs here, there, and everywhere, and sanctions here, there, and everywhere, that invites what? That invites me to try to lobby to receive exemptions from tariffs if I'm an importer. I don't want to pay those taxes. So I lobby to get an exemption. And this is exactly what happened, by the way, in Trump's first term. There were a tremendous number of exemptions on these tariffs that he was putting in. There'll be even more of that. So there'll be much more corruption. And it's a bipartisan thing. It's totally bipartisan. I said Biden, we had an explosion of lobbying and corruption with Biden, and I anticipate we're going to get more of the same with Trump, because every one of these government policies and threats and so forth that Trump makes always lead to people wanting to buy their way out of those costs that would be imposed by tariffs, for example. So okay. It's going to be great for the industry of lobbyists will be booming.
When you said earlier that the economy is slowing down because we talked about this many times, the quantity theory of money said it would. What needs to be done to reverse it? Suppose Trump wants to have an economy that is not in a recession in his first year of office, right? What does he and or the Fed need to do?
In a way, there's not much he can do about it, because it is baked in the cake, because the effect of monetary changes and the supply of money, they go through a transmission mechanism. You change the supply of money, and it takes a while for it to work its way through the system. But what is happening right now to the data we are viewing about inflation, about bond yields and things, real economic activity, those were all caused by changes in the money supply that happened a year ago, 2 years ago, maybe even 3 years ago. Mm-hmm. So that's the baked in the cake part of the thing. You can't just, this idea somehow that you can just turn a switch and change things overnight. It doesn't happen that way.
You've been spot on calling for.
By the way, there is one aspect that you can change right away, and that's business sentiment. So let us assume that after January 20th, this euphoria that's kind of surrounding Trump right now, let's say that continues or even increases. Well, that aspect of confidence would mitigate to some extent the effect of the changes in the money supply that are eventually going to cause the economy to slow down. You see, they kind of offset a little bit. If business confidence is hot and revved up because, for whatever reason, people think Trump's doing the right thing, they're very confident, that is a boost. That's a positive. That would offset what I think is baked in the cake, a negative, because a couple of years ago, we have the money supply starting to contract, and that's working its way slowly through the system.
The quantitative theory of money says that we will have a slowdown. You were right in calling for inflation to come down because of the theory of, because of the formula. Are you surprised that inflation came down first and we haven't had a recession yet? In other words, the slowdown came later, or is coming later, perhaps?
Not really, because there's you say the formula. Well, there is a quantity theory of money. MV equals PY. Money plus the velocity equals the price level plus the real change in economic activity. That is a formula. But to use it and interpret things, and there is an art to it also. And so the art part, I was not really surprised. The thing doesn't work mechanically because there are, as they say, long and variable lags between changes in the money supply, changes, and then next come changes in the asset prices, usually stock market, real estate prices, land prices, things like that. And then changes in real economic activity come next, and ultimately changes in inflation. So usually inflation does, in fact, come after changes in real economic activity, not in front of. But that doesn't always occur.
Is it not possible now that the inflation rate, which has come down since its peak, that is the only result that we'll see from this monetary-based contraction? In other words, we will probably not, this is just a theory I'm positing to you, that we will not get a recession anymore.
Well,
it's already, the time's already passed for that.
No, I don't think that's going to be the case. Again, anything is possible, but this is not. What you're saying is not very possible.
Okay,
there's a very small chance that we'll have kind of a, shall we say, what they call a soft landing, and the reason for that, David, is that it's very unusual to get an actual contraction in the money supply like we've witnessed since July of 2022. We've only had it 4 times since 1913. And every time it's led to a recession. And that's all consistent with the quantity theory of money. So it's consistent with the theory. It's consistent with what actually has happened historically. And I see no reason why it won't happen now. The only thing that's different and it is the fact that it looks like the lag between changes in the money supply and changes in real economic activity, the lag is going to be a lot longer than historically has been the case. And the reason for that, looking at it carefully, is that the money supply zoomed up so fast and there was so much excess, shall we say, overhang in the system that it's taken a while to burn all that off. It has burned off now, and to get back on kind of a normal course. So the unusual part of the contraction is that prior to the contraction, there was a huge excess of money in the system that was built up from the massive increase in the money supply that started in February of 2020 and went into well into 2021.
Let's talk about what happened at the last FOMC meeting. Powell kind of shocked the markets, as you recall, when it happened in mid-December. There was a big drawdown in equities. The S&P dropped about 3%. The NASDAQ was down 4% on the day. And this is what happened. Powell essentially said that they're going to be a bit more cautious in cutting rates. He was referring to the CPI. As you know, the CPI, headline CPI was 2.4% in September, then climbed to 2.6% in October, and then it climbed to 2.7% in the last print in November. Is Powell right to be concerned about inflation remaining sticky and them losing the fight, so to speak, against inflation?
No, I don't think he is right. And by the way, you said the last number is 2.7%. That's the reading for November. Now, December will of course be the last month in the year, and Greenwood and I predicted for a long time that inflation would end the year between 2.5 and 3% per year. And we hit the bullseye again using the quantity theory of money. So that's one point. Now, the point where Powell is wrong and what's getting the guy off balance is that the Fed has no theory for national income determination. Greenwood and I do. We're monetarists, and we follow the quantity theory of money. But the Fed has no theory about what's going to happen. And they've never been able to forecast where inflation is going, by the way. So his concern over inflation being sticky. They have no model. They have no idea what's going on. They are data dependent. They're watching the daily and weekly and monthly data. They have their finger in the wind trying to figure out what in the world's going on without any model. They have no theory. So this is, remember when I used to use this phrase, David, with you, they're flying blind.
Okay,
And,
so you've been pretty,
and that's why he's off base. He literally doesn't know what he's doing. He's waiting for the next number. If all of a sudden inflation numbers start coming in lower again and stop this little stickiness that we're in temporarily, which I think that will happen, he will change his tune again, and he'll go back to saying we're gonna lower the Fed funds rate. Not 2 times. We're going to go back to the old 4 times in 2025.
I understand what you're saying. They're backwards data dependent. They're looking at the rear view mirror. If you know, this is another quote you make frequently. But Professor, keep in mind that if the Fed were to, let's say, adopt your model and they were forward looking, they would make monetary policy decisions ahead of what the actual economic data as presented by the BLS would indicate once it comes out. In other words, wouldn't their policies become a self-fulfilling prophecy? They don't want to do that, right?
Well, all they'd have to do is keep the money supply growing at Hanke's golden growth rate, about 6% per year. That rate is consistent with hitting the Fed's target of 2%. And we wouldn't have these roller coaster rides, David, where we go up and down, up and down, up and down. Money supply goes up, inflation goes up. Money supply goes down, inflation goes down. That it would be more, if you looked at inflation or the money supply, they'd be kind of horizontal lines, kind of flat lines going across that chart. You've got a chart up there now, and you look at all the, look at those peaks and troughs and the thing. That would be eliminated.
So to have good, sustainable economic growth, we need inflation that is range bound. Where roughly 2.5 to 3%?
Well, the Fed's target is 2%. So if we take that as being the target, then they should be organizing monetary policy in such a way that the broad money rate of growth measured by M2 was about 6% per year.
All right.
And that's what it was, by the way, through almost all the Greenspan years. So that's the theory, okay? That's the forward-looking number and everything. If we go back historically, look at Greenspan in the 1990s, David. That's about what was happening. The money supply was growing about 5 or 6%. The inflation was a little tiny bit below the target. Economic real growth was good. Everything was stable. And you had, by the way, you had Clinton in the White House, and the Speaker of the House was Newt Gingrich, and they were battling it out. But the result was fiscal policy was in fact very stable and very tight. Remember, with Clinton was the most conservative fiscalist we've had since World War II.
Yes,
he was even more conservative than either Dwight Eisenhower or Ronald Reagan.
Can we take a look at one more clip I'd like to play for you from the FOMC meeting? Take a look at this question on tariffs.
Great. And just a quick follow. Given the recent bout of inflation that we've been through, with consumers seeing how prices can rise and businesses seeing that they can raise prices at least for some time, does that make it a little bit riskier to look through tariffs? I mean, do you feel you have to respond more quickly to inflation threats, given what we've seen in the past few years?
So the main thing is, and this is also a point in these alternative simulations, is there are just many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion. We don't know what will be tariffed from what countries, for how long, in what size. We don't know whether there'll be retaliatory tariffs. We don't know what the transmission of any of that will be into consumer prices. To your point as well, I wouldn't say that we know whether the last episode is or is not a good model for what happened.
Can we please just evaluate what Powell just said?
Yeah. Number one, what he said that I agree with. We don't know what Trump's going to do, and we don't know what counterattacks and retaliatory moves those who are facing new tariffs will react with. So we don't know. And he obviously has some kind of models they're using to indicate what effects the tariffs would have. But remember, the tariffs won't have any effect on inflation. They will affect the prices of certain goods and services, and those price changes are relative price changes. They're not changes in inflation. They're changes in particular goods and services relative to other goods and services. So tariffs don't cause inflation. Changes in the money supply cause inflation.
But the Fed primarily would be in charge of the money supply. So if they don't if they don't know what the impact of tariffs would be on consumer prices, then we can expect no changes to the money supply in response to tariffs. Is that basically what you're saying?
Yeah. In other words, if let's say the whole thing in their modeling exercise at the Fed is so uncertain, they decide to do nothing.
Yeah.
Relative to when the tariffs were put in. If that's the case, then nothing changes. The money supply will go in the direction it had previously been going in, and inflation will be going in the same direction that it was going in, and basically nothing will change.
Ultimately,
now, if they react, by the way, to tariff, if their model shows them that somehow tariffs would be going up, and that would affect the overall price index, consumer price index, for example, in a negative way, meaning that the prices would be going up. Inflation would be going up, I should say, not the relative prices, but inflation would. Then they would probably react by tightening and slowing the money supply, which means that actually the tariffs caused what? The tariffs began. The reaction of the Fed would be to tighten up the money supply and slow it down, and that would eventually do what? It would actually slow the CPI. It wouldn't increase it. It would be just the opposite of what everybody's saying right now. Everybody's saying that the tariffs that Trump's going to impose will create inflation. Well, that whether we have more inflation or less inflation depends on the Fed. And if for some reason the Fed reacts to increasing tariffs by tightening the money supply, we'll actually get not an increase in inflation, we'll get a decrease.
Okay. So ultimately then, you and Mr. Greenwood are going to be right on your 2.5 to 3% call by the end of the year. There's, close to a 0% chance it will fall outside of that target by the end of the coming week. So what is your ultimate target for the next year, 2025? Did you update it?
We don't have an end of year target yet, but
okay.
But sometime during the year, during next year, 2025, I do think that the headline CPI number will drop below the Fed's target of 2%. Now, if that happens, by the way, the interesting part from an investment angle, because the investment, Wall Street just has this all wrong. And yields on bonds follow inflation. So if what I just told you about, based on the quantity theory of money, was that inflation will fall from where it is now, 2.7%, to something below 2%. What's going to happen to bond yields? They're going to go down.
Yes.
So that means that the 10-year bond right now is a tremendous trade. You should be buying it, because if you do buy it, the yield on that bond is good now, but it's going to go down, and you'll be able to realize a capital gain on that investment or
You think
trade.
you think the bond market is wrong to price in higher inflation? Is that what's happening right now? The 10-year yield going up to 4.6%. They're just
It's just completely wrong.
okay.
They think that the bond market is bought into this idea that the fiscal deficit will go up in the coming years, and that will cause the federal government to be forced to issue more bonds. And the only way people will buy those bonds is if they're getting a higher yield off the bonds. But that's not the way bond markets work. Bond yields follow inflation, and inflation follows changes in the money supply. So again, you have to start with the changes in the money supply. That will give you changes in inflation, again, with a long lag between changes in the money supply and inflation. And eventually, yields will follow the inflation. Now, where the bond market gets fouled up, they've forgotten, because none of them learned their monetary economics very well, amazingly. They've forgotten to be looking at what's been going on to the money supply a couple of years ago.
Yeah.
They're looking at what's going on today.
Okay, Professor. I think that was a very good recap of current events and outlook. Let's end it here. Lots to discuss in the coming weeks, closer to inauguration. So more news to bring up.
I think my closing remark, David, would be overpriced, overvalued, overhyped.
What is something that is not overhyped right now for an investor?
Well, there's some things that are actually not overhyped. They're overhyped in a way. Let us just take something like lithium. Lithium has been in the tank now collapsed in the last year and a half, 2 years, its price. And everybody says, it's going to stay in the tank because the use of lithium, one of the big uses, by the way, is batteries. And the sales of electric vehicles isn't as robust as everybody thought it was going to be. So the demand for lithium is not going to be there. And so in a way, you get a bearish overhype. You can have bearish overhypes as well as bullish overhypes. I think lithium is an example of a bearish overhype. So that would be one. And there are other commodities, by the way, that fall into this category.
Good. Well, I mentioned in the beginning we can reach you. What is your email and your X handle?
The X handle is at Steve_Hanke. My email address is hanke@jhu.edu. And my most recent book that I co-authored with Leland Yeager, if you could put that up with the Springer link, is called Capital Interest and Waiting. If you really want to get into how the financial markets work, how the capital markets work, and the importance of waiting, that is, not deferring consumption to receive an interest or rate of return so that you can consume even more tomorrow, that book has got it all.
Excellent. We'll put the links down below, so make sure to follow Professor Hanke there and read his book. We'll talk more about that book in the new year. Happy New Year, Professor Hanke. Thank you from all of us watching for being here this year, for being a part of the program and educating us throughout 2024 and on to better things in 2025. Thank you.
Well, I'm looking forward to being with you in 2025, David.
Absolutely.
Thank
you for having me.
Yeah, we're very
privileged to have you.
You.
Happy New Year. Happy New Year to everyone. We'll keep in touch and see you in 2025. Thanks for watching. Don't forget to like and subscribe.